Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast. I'm your host, Christian Allen. With me, as always, Rod the Pod Zabriskie. Rod, what's up, man?
Hey, I'm doing great. I'm always doing extra great when we have extra guests.
Okay, so we have, I don't know what to call them. Are they guests or are they co-hosts?
Guest co-host?
Guest co-host.
Do we go both?
Okay, we'll go both. Okay, we have our good friends, Blake Never Takes a Break, Brogan, and Brenyn Babyface McConnell. So we are ready to go. The whole stack is here. And I asked them to come in because, one, I really like that we're talking to people who are actively just like out there on the front lines. Rod is obviously doing that, but I don't do a lot of client interaction. And so I feel like it's a good opportunity for us to like get in the trenches, understand what's actually happening out there. And we did a podcast a few weeks ago that inspired this one. And what I wanted to make sure we focused on today, guys, and obviously this is what you guys have been prepped on this, but we're going to talk about 8 things. Okay, I should say it this way. Each one of you were asked to come with 2 things that you wish every investor knew about high cash value life insurance, right? So again, we're talking about people who literally have these conversations every single day. And so my hope is that we can come up with some interesting insights. Now, almost certainly we're going to have more than 8. I've got a much bigger list. It sounds like you guys have some extras on there. We'll just go with whatever makes sense. We'll just roll with it. But the key is that we are going to have 2 each. Now, how do we start? I think we're going to start from oldest to youngest. That's just easiest, Rod. We're going to start with you. You're going to give us our...
You were just assuming?
Oh, sorry. Yeah, I thought everybody knew that.
Guys, who's the oldest here?
I was expecting we'd like ask for birth dates or something, but
you guys want to put them in the chat so that I make sure that I'm accurate on it. Actually, as I'm saying that, I'm questioning it because that puts me second and I want to wait till after you guys have gone. So here's what we're actually going to do. I'm going to give you guys a chance to give all of your points before I bring mine in. That's because I've got a much bigger list of that I can add to what we're talking about. So that being the case, we are still, Rod, I apologize. We're still going to go oldest to youngest, but we're skipping me. So Rod, kick us off with, and maybe, well, I was just going to say, is there anything you have to say before we launch into it that I didn't say that needs to be said to set the stage?
So for me, when I was putting these together, yes, I was focused on high cash value life insurance, especially in the context of the way that we use them in our strategies, like the investment optimizer. So I'll give context like on one of my points if it is more specific, but I just want to kind of give that background because that's the frame of reference.
Okay, that's a good point.
When I put them together,
that is a really good point. A lot of it is going to be based on the strategies that we use. Some of it will be more general, but a lot of it will be really laser focused on an investor's wealth building journey and how high cash value life insurance fits inside of that. Okay, but what I'm not going to do, Rod, is I'm not going to let you go 2. We're going to do a snake style draft, and we're going to go Rod, Blake, Brenyn, Blake, Rod. Okay. All right, and then I'll cover some at the end. Okay, Rod, kick us off with our first thing that you wish people, investors, clients of ours, everybody knew about high cash value life insurance.
Okay, so this is something we run into all the time, and it often comes from, well, I'll say from 2 places. People for whom this is the brand new concept. They never even knew much about high cash value life insurance, but it's also something that comes from people who are very familiar with it, maybe learn about the investment optimizer, but still don't quite grasp this concept. And it's that the policy, again, especially in the context of the investment optimizer, the policy is not the investment. We're not trying to
Rod
make
took the low-hanging fruit, and I'm glad you did because it's like it's probably the one that jumps out to us the very most, right? Whenever we get somebody that's like, hey, why would I put money in there and get, 5 or 6% when I can get 12 or 14% in my real estate?
Yeah.
And we're like, like banging our heads. We're like, you don't do one or the other, you do both, right?
Yep. Yep.
So anyway, that's a good one. How often do you run into that these days? Still a lot, I'm sure.
Yeah, and again, it's in some variations, right? Because even for people who I know they get the concept, maybe they've seen a webinar, we've met once or twice, they've seen the additional content that we've sent over. I think it's just so easy to get drawn back into, wait, you want me to put money someplace where it's going to get me 5% tax free when like it?
Yeah.
I think anyway, it's very common. Again, that's why I brought it up. I don't blame anybody for it. It's you kind of get lost in the journey, so to speak.
Yeah, and it's easy to do because it's an extra step that you may not have been taking before. The easiest way that I would say is just if we can just remind people, we're swapping out the savings account for the policy. Now we're just investing through the policy. It's like once you get it, it actually is pretty simple. It's pretty easy.
Yeah.
But I totally understand especially when you come from a traditional wealth building mindset, this is can become a little bit cloudy. So I'm glad you hit on that one, Rod. I think it's probably the number one across the board. Did anybody else think of this one, have that on their list? All right. Blake's got it on his list. Brennan, did you have it on yours?
I didn't write it down, but I thought about it.
Okay.
It was a thought. So
Brennan was like, I bet Rod's going to bring this up. I'm going to go with something a little more advanced.
Especially if Rod goes
something
first.
that these beginners won't bring to the table.
Yeah, those guys are messing with like associates, bachelor degrees. I'm talking master's degree.
Yeah, he's going deep dive.
All right.
Okay, well, I think that's a great one. Do either of you have anything else to add to that point? No?
It's the easiest thing to mix up, but
okay.
I do
And super important.
I do feel like a lot of times what happens is people get hung up on that before they actually understand how the strategy works, and they can't move past it. It's like almost like a barrier that they can't get past, and they can't understand the strategy because they're so hung up on, why would I put money into something that's going to earn 5 or 6%? But if people can get past that barrier and understand the strategy, then it clicks. But for some reason, I just have had people that just get so hung up on that, they're not willing to look past or at the overall strategy. And then you just can't.
It is. It's an unfortunate bottleneck that can occur. And I will say this, it's not uncommon. It's not been uncommon throughout our journey in teaching this stuff that people will come the first time and have that hurdle. And then they'll come back a couple years later and finally things have clicked and they're ready to move in that direction. So it is one of those things that has to kind of click it. Okay. I think that's a really good one. Blake, that means you are up, my friend. What do you got?
Okay. So I'm going to go with the death benefit is more important than you think. And what I mean by that is I'm not out here going to be, pitching, hey, if you die, your family needs to be taken care of. Now, I do believe that, but as we're setting up these policies, it's pretty often where someone will be like, Blake, I don't care about the death benefit at all. I just want to maximize my return in the policy. And it's like, you can do both. Okay. At the end of the day, this is a life insurance policy, but here's why I say this. Here's the benefits that the death benefit gives you, even if you're not interested in, maybe the estate planning play. So when you take a policy loan to go out and invest, there's no repayment terms, right? One of the reasons that there's no repayment terms is because if you were to pass away, that death benefit's going to take the loan. So that death benefit as you're investing gives you a lot more control over when, or frankly, even if you end up repaying those loans. Secondly, as you get into the quote unquote retirement phase or, the passive cash flow phase, we can take withdrawals from the cash value at some point, but eventually, if you want to keep taking all the money out of the policy tax-free, we can flip over to loans. Well, how are those loans going to get repaid? It's through the death benefit. So even if you're setting up the policy where you're like, I want to maximize my returns as I'm investing, I want to create an additional tax-free income source in my life, the way that we're able to accomplish those things is by having that death benefit. So even if you're not interested in estate planning, that death benefit is going to allow you to generate a lot of tax-free income down the road.
Man, I love it. And this is definitely master's level stuff, Brennan. You're going to have your work cut out for you to go above where Blake's taken us. So a couple of thoughts, or just one quick thought in addition to. So I love both those points you made. I would also say that for people that don't think it's important initially, those people often do start to believe that death benefits are important as they get further into it. So if I'm starting a policy at 32 and, you know, I've got a really good income, I'm really focused on my investments, it seems like that same person at 50 has a lot more focus on the death benefit, because to your point, you don't have to choose between doing both. Like the reality is that by max funding the policies in the way that we teach people to do it, I actually, especially if I live a long life, I actually create more death benefit than I would if I had tried to build the policy to create for death benefit in the beginning. So anyway, my point is just to say, while it's not always important to people today, my experience is that it almost always becomes important to people over time, because a lot of times people get to a place when once you get into this, like that wealth builder's frame of mind, things begin to escalate, and suddenly this policy may become something you don't even need, and now it is an estate planning play, it is a wealth transfer play. And most people that are wealth builders, if they have the choice between passing it on to their family or to the IRS, they usually would like to pass it on to their family. So anyway, I think that's a powerful one. Blake, does anyone have anything they want to add to Blake's point?
Yeah, I had it actually as a variation on that.
Nice.
The way I worded it is that even though we're keeping the costs as low as possible, therefore, you know, we're keeping the insurance as low as possible, you still get a pretty healthy amount of insurance on there. So if you're 40 years old and you're putting $100,000 a year into your policy, even though we've minimized it, you're still going to get, you know, $1.8 million of insurance or something that you don't have to pay for any other way, right? That's going to take care of your family if something happens to you. So,
And when you're talking about financial freedom, like life insurance, I think there's nobody that I've talked to who just logically believes that part of things doesn't matter. So why not make your policy multifaceted, position it to do both of those things? And of course, the good news is whether they like it or not, it's still happening. So that's good.
Yeah.
You know what I mean? Okay. I like it.
Was similar. Mine is more legacy play. So one of my points was that I don't need that much to pass on to my children.
Yeah. Okay.
Yeah.
Okay. And that definitely fits into that kind of variation of it.
Yeah.
Okay. Brennan, we are on point number 3. Where are you taking us?
Okay, these guys have been doing some book smarts. I'm gonna flip the script and go street smart.
All right, I love it.
So one of my first point actually is that when people are looking at policies, they think the initial cash value is the most important, but they fail to look at the cash value growth in years 10, 20, 30, and beyond.
Yes.
So that can be a problem. So while that year one cash value is a great indicator, it's one of a few indicators, right? Just because there's the highest cash value that first year doesn't mean that you've got the best policy that you're looking at. And when I take people through that, if we're looking at like an apples to apples comparison, they've really just been focusing on like the first year, maybe the first 5 years of the policy. And then when I start taking them through, let's look at year 10, year 20, year 30, let's look at it when you're 90 years old. In some cases, the initial cash value might be, 10, 15, 20,000 more than what we're showing on the other. But if you look at 15 years down the road, there's $100,000 difference in the policy that had a little bit lower initial cash value. And so I think people are kind of trained. And again, there's a lot of truth to it that you want the highest amount of cash value that you can the first year, but that's not the only indicator of the best and most efficient policy. And so the biggest thing is that you need to look at the life of the policy. You need to look at the first year, but you also need to look midway through the policy and then at the end of the policy. There was one the other day that I went through with a client, and they were going to put in an extra $300,000 over 10 years. And they liked it because they were showing 35,000 more of cash value the first year. And this client was a little bit more death benefit focused anyway. He likes the idea of the cash value being accessible, but it's a higher net worth individual, and he's really looking at death benefit for estate planning. Well, at the age of 85, there was a $5 million difference in favor of the company that had the lower initial cash value, $5 million. And he could fund $300,000 less over 10 years. So it can be, I know it seems obvious, but people just fail. They just really focus on those first few years and they fail to look at the life of the policy. And that can be a big mistake. And so just make sure you look at the full policy details, not just the first few years.
Yep. I like it. I had one of my points that design is everything, and it fits in that same model, right? Like the design has to be right, but it has to be right for the person and the situation. And so for some people, we might recommend like the highest cash value policy, the highest first year cash value policy. But for a lot of people, like we're probably going to be focused more often on the medium to long term, where we see, you know, the impact of cost control and just making sure the design is built to work for them the entirety of the contract, not just in the first few years. Okay. Really good point. Okay, Brennan, you get to go twice. So we're on our snake draft.
Because you brought such a great point.
Give
you another one.
It was so awesome. We gotta. Let's keep are you going street smarts or book smarts on this one?
You know, I feel like I kind of want to hit on to. We'll go book smart here.
Let's hear it.
So the payments are rigid, and if I miss a payment, the policy blows up. That's a misconception.
So you're saying like that's one of those things that people misunderstand really like commonly, and wish we understood that there was more flexibility in the policies than they probably think.
Yeah, and I think not only more, I think there's a huge amount of flexibility that a lot of people don't realize is there. And I think that can be, you know, sometimes when I even speak with somebody for the first time, they'll even bring it up and say, hey, I you know, for the last 10 years, I've known about this, but from what I've heard, whole life policies are really rigid. And what they'll say a lot is, and if for some reason I had to miss a payment in 5 or 6 years, I heard that the policies blow up. And I don't know if I'm teaching that online, but I feel like it's the same.
Okay, so
wording.
I think I can answer that. So what happens is, from the insurance companies themselves, they go and they put the policies in different categories. And universal life is supposed to be the flexible one because they built it to be flexible, right? And whole life is supposed to be like the dinosaur, the rigid one, but it has no indication, or they're not taking into account what happens when you overfund a policy. So I remember Jerry Barman, he's been on this podcast before, but he's an expert in life insurance, and that's kind of what his whole career has been about. And he did a paper that was basically talking about the opposite, where to your point, whole life insurance, when you overfund it, it actually becomes the most flexible type of contract rather than the least, which again, I just think it gets put in these categories where it's like term is this, universal life is this, whole life is this. And then it's just kind of what the narrative is out there. That's my take on it. What do you guys think?
Yeah, and I think, just adding before I let the others chime in real quick too, I think what a lot of people don't realize is that when we structure these policies correctly, the first few years, there might be a little bit of structure in terms of what we want the client to contribute, but they can get the policy to a place pretty quickly. Usually by about year 3 or 4, we can get the policy to a place really quickly where if they had to miss payments, or in a matter, well, not only if they had to miss payments, if they had to stop making payments, we can get the policy to a place where it's not only going to survive, but it's efficient moving forward.
So I have my 12X rule on my list, which is 12 times base premium gives us freedom, basically, right? So gives us the freedom and flexibility to allow us to take loans, to not take, like, we can basically do whatever we want with the policy once it's gotten to that place. We just need to get it there. Now, I think it is important, to your point, from the flexibility standpoint, people have to understand that even in the first year, like what's happening is when we talk about overfunding and we talk about putting in paid up additions, what's happening is I'm quite literally funding 4 years worth of a contract, sometimes 4 to 5 years, depending on where the base premium lies, in 1 year. So the reality is if I made that one premium payment in the first year, I could let the policy ride for a few years without it ever being in danger of actually lapsing, because it has the cash value there. Now, that's not the goal, right? Our goal is to continue to flush as much cash in it as possible. But from a pure flexibility standpoint, I could go a year, skip a year, and then keep going, and it would be just fine. Like, it'd be no problem. So I think it's a really important point, and it is one of those things that's commonly misunderstood by investors and really people as they come into our world. That's one that's really common that we have to kind of make sure that we talk them through, right?
And as much as we do emphasize that on the front end, I've had a bunch of conversations with people who have had policies for multiple years, and they'll say stuff like, oh man, this is way more flexible than I ever thought. And I'm like, well, we kind of tried to prepare you to think about it this way. But then when they get into real situations of accessing the cash value for investing, or of they're a business owner and they're in a bit of a cash crunch, what are we going to do? I was like, oh, okay, well, let's talk through your different options. And that's just commonly the response. Oh man, this is way more flexible than I thought.
Good call. Okay, good stuff, Brennan. All right, Blake, we're going back to you. We're on number 5.
So the 4 things I wrote down were basically the first 4 we hit on. So I'm going to pivot, and say, hopefully people know when you set up these policies, when you access the cash, you can use it for anything you want, right? There's no restrictions. The insurance company's not saying, what are you going to use the money for? When are you going to pay us back? Anything like that. You just say, send me X amount of dollars, and they wire it into your account. So that being said, if you think you're going to build wealth by going out and using it on depreciating assets or on vacations, or you're going to get rich buying cars, I don't really think the math adds up to that. So when we talk about the investment optimizer, one of the things I think that makes us a little bit different than a lot of other maybe promoters of the strategies, we're working with, people looking to build wealth, and we build wealth through alternative investments or other cash flowing assets. So, we'll run a side-by-side, which maybe a lot of you have seen. Hey, here's what it looks like if you use the investment optimizer versus the savings account. And the people who don't use the investment optimizer are still creating a lot of wealth, right? In our kind of projections, the investment optimizer just adds, a couple $1,000,000 to your investment returns over the course of 20 years. So the real wealth building is actually not in the policy. Just by flowing money in and out of the policy, you're not just creating wealth. It's just adding on top of the true wealth building, which is happening outside of the policy.
So the way I talk about that is like the policy is the engine, right? Like that's the engine that we're using. It's the framework that we're using as our core starting point. Then we go and invest. And of course it enhances any of the investing that we're doing. Okay. I like it. Good stuff.
Yeah, I have a thought on that.
Please.
That it used to be just kind of theory when we would talk about this, comparing what you were talking about, Blake. If people are going out and using loans to buy their cars, go on vacations, do these different things, consumer driven stuff, because they're counting on the loan creating that arbitrage for them. And we would always talk about, well, that isn't necessarily always the case. You could have a situation where the loan rate is going to be higher than what you're earning on your cash value. And so don't count on it. Well, as we speak at this moment, one of the major companies that the infinite bankers like to use is now underwater. Their interest rate on the loan, I don't remember the exact number, but it's like 6.2 or something, but they're paying like 5.5 on their dividends. And so people are surprised, shocked. Wait, this isn't supposed to happen. I have this large loan out there that I'm supposed to be continually arbitraging, and it's not turning out to be that right now.
So really the lesson, and this is a really good one. So it's just kind of like a bonus that's getting out there. And that is gets to the broader concept that, so maybe some context. The infinite bankers think that you should always use non-direct recognition, right?
Mhm.
So what we're really saying is that the non-direct versus direct recognition shouldn't be what you're using to determine the policy that you work with, right? Like that's it. Too many people go in and they're like, oh, I have to use a non-direct recognition situation because that way I can create this arbitrage effect that you're talking about
Always.
without realizing the impact of the negative arbitrage that exists there. So what we always tell people is the cash value growth is far more important in a policy design than is whether we're talking about direct or non-direct recognition, right? And of course, the nice thing with direct recognition is it's super safe. You know what you're going to get, so you can plan a little bit easier around that from an investing, flowing money in and out standpoint. But again, shouldn't be the deciding factor.
Right. Yep. And then, so getting back to Blake's whole point, now we get back to the concept of, well, let's just use loans to go out and create value. Let's not take the loan for the loan's sake and just for that little arbitrage we're able to create there. Let's go create a lot more value with what we're doing with that money.
Yep. I love it.
Then it works either way. Doesn't matter.
Good stuff. Okay, I've still got some on my list that you guys haven't hit on yet, so that's good news.
All right.
Okay, Rod, bring us home. We're on number 6. What do you got?
So the next one I'm going to talk about is that all the money that I'm going to be putting into my investments, I want to get into my policy first.
So you wish every investor knew that they should flow all of their investment money through the policy first.
Yes. In saying that, I know that it doesn't always work, right? If I have a large liquidity event, well, I can't fit all of that necessarily into my policy, but that's my aim. Like if the strategy is creating more value in my world by flowing the money through it, then I would rather have all the money that's going into my investments flowing through it.
Okay. This hits on one of my top ones that was left, and I'm going to kind of lump it in with yours.
Okay.
But it's capitalization multiplies impact, right? Across your entire financial world. So it kind of is two-sided. On one side, it's what you're talking about. It's also the idea that people go in thinking, okay, I'm going to fund for a specific amount of time, but not realizing that it doesn't just help like my singular investment by continuing to flow money into the policy, build up the capacity in it. I'm touching and giving myself an opportunity to build more wealth in every part of my financial world. So again, this idea that, hey, I want to fund for this specific period of time. And I actually have another one that goes with this, and that is paid up additions. Paid up does not equal done funding, right? So just because I could stop funding doesn't mean I want to. In fact, I would argue that what most people see is that the impact, again, the more I capitalize it, the more impact I get. So just because I've funded it to the point where it's going to run and do its thing and earn the return that we talk about, doesn't mean I shouldn't continue to push it, because of course, if I do that, it continues to grow impact.
Yeah. And I want to be really clear about what I'm not saying. I'm not saying that everyone should go big to make sure that we
that's a good
capture all
point.
that money in there, because we do want to be smart about what we're doing. And when we're at the beginning of this conversation, we're asking the person, okay, well, what are you reasonably expecting you'll be putting into your investments? And we want to start there. I'm not asking where do you think you'll get to be in 3, 4, 5 years as you get raises in your work situation, as you get better returns in your investments, whatever. We can grow the plan to match or to increase your funding capacity as time goes on. We'll start with where you are now, what you realistically feel like you can put in, and then we can stack policies later. If you get to a place where you have more money coming into your world than you can fit into what you have, stack new policies to increase that capacity.
Okay, I love it. Does anybody have any other points that they want to throw out there that we haven't hit on yet? Anybody? Okay, well, we've come up with a lot. Okay, so I do have a list of some other ones that I can bring into I'm trying to decide which ones I want to. So we hit on the 12x rule, right? I talked about paid up additions. It doesn't mean stop funding. How about this one? The policy is not a trophy, it's a tool. What does that mean? It means that it's designed to actually be used. So very often people like the idea. They come, I shouldn't say very often, but occasionally we have people who really like the idea. They come in really excited. Maybe they're moving into the alternative space. They put their money in the policy and it just sits there and they never do anything above and beyond just having it sit in the policy. Now, I'll be clear. That's not a bad place for your money, but I'll get a 5 to 6% tax-free return, which is, going to beat inflation and be reasonably good.
Yeah,
but that's
otherwise going to sit in the savings account, right? Or the bank,
yeah. So if it's like, if you're just saying, sit here or sit there, you might as well set it in the policy. But the point here is that the way we design this and the strategies that we're talking about are designed to be like proactive, to use to go out and fund deals and look for opportunities and, again, build your entire financial world. So that's one of them that kind of comes to my mind that we see, I would say less often today than we have in the past. But I remember early on, there was a lot more people who would put money in and then they just weren't using it. Right. So if you come in here and you're like, I love this alternative asset investing thing, I love the idea of running money through my policy to create extra return, then my advice is actually do it. Crazy, right? Crazy. Okay.
I like it.
Let's see. So I'm going to make sure that we talked about all these. It's an investment, or it's not an investment. It's an engine. Okay. We talked about that. We talked about design, capitalization multiplies impact, the 12X rule, paid up equals done funding. Why wealthy people use it differently? Why wealthy people? Okay. I'm trying to decide if I like that point or not. Because I think at the end of the day, it's probably okay. Here's one I like: the cost myth. I just struggle when people come to me with cost. So sometimes we'll have people who, you'll go and you'll describe the benefits of the policy. So let's just say I'm going through it and I'm like, okay, it's safe, it's predictable, it's tax-free. I'm getting, a 5 to 6% return on it, and yada, yada, yada. Okay. I have the death benefit. I have all these great benefits. And a lot of times people will say, well, how much does it cost? How much does it cost? And I always look at that and I'm like, okay, I totally get the premise. We're programmed to ask about how much something costs, because there's nowhere we're getting something for nothing. And I do think it's important to understand the economics of policies. But the point that I'm trying to hit on as it relates to cost is when people struggle to get past the idea that I would pay 1% or 1.5% to have a liquid 5.5 to 6% return consistently doing its thing. Because whenever we're teaching it, we're teaching net of cost, right? Yeah. It's not like, hey, you get this 6% return, but then there's a 2% drag on it after that. And I think what happens is sometimes you have people who get so caught up on the idea of cost and like what it's going to look like inside of a policy, and they lose sight of the fact that it's actually going to produce this. So another thing that I would add on to this, that I wish investors knew, is that these policies pretty much do what we show them doing. So if we were to stack up a policy that we wrote a decade ago and show it today, it would look very, very close to the original illustration, right? One of the things we love about high cash value life insurance, and specifically whole life insurance in this case, is that it does exactly what you expect it to do. And the cost part of it probably shouldn't be one of those forefront issues, right? It should be one of those things that we understand within the economics of how life insurance companies get paid. But in terms of when we're looking at our actual policy, we want to be looking at and focusing on the net benefit that exists, not getting too hyper focused on the cost. Okay. Sequence of returns hedge. I've got sequence of returns hedge. I wish investors knew that you could use it as a multi-purposed asset where you could, what do they call that? What's the strategy called? Buffer. The volatility buffer. Man, can I just tell you that concept that those guys made up has gotten a lot of play over the last 15 years, hasn't it? But it's a good concept. And the idea is just that the policy can be multi-purpose. In this case, it can be a buffer against, investment volatility and maybe our more traditional assets, or if you're me, more against more volatile assets like Bitcoin or something like that. You know what I
Yeah.
mean? So if you're a big Bitcoin investor, then, or, you know, a crypto investor, this can still act as a really powerful volatility buffer to let you use money that's in a stable place, knowing that, you know, other money might be on a little bit more of a wild ride with the expectation that I'm going to grow more over the long run. Okay. I think I got all of them. I mean, I have a
had
few
one
more
more
on here, but please, Rod, bonus.
One more I had
Rod.
was, I'm surprised how often I hear people saying, okay, so I'm going to have to put money into this for 3 or 4 years before I can start using it, right? There are people out there that are teaching that, and we are not one of them, because when I start putting money into my policy, I can start accessing it right away. I don't have to wait. To the extent I have cash value in my policy, I can start loaning against that and go use it.
Okay, that's a good one. And that is one that we run into, because to your point, people, and maybe it's just that people hear what they want to hear and that becomes a concern. But to your point, we can usually get money 30 days after we've put it in, right? So if I put 100 grand into my policy for the first year's premiums, most of that's going to be used to invest. I can pull money back out of it a month later, and I'm on my way, ready to roll, investing in whatever deal I want to.
Yep.
Okay. Is there anything that we missed? I mean, I'm sure there's other things we could bring up, but is there anything just like weighing on you guys that we want to hit on? This is probably a good list.
A quick one.
Yeah, I love it. Bring it.
Okay. So I'm actually surprised at how often I hear I don't need that much to pass on to my children.
Yes. And that one is always a little weird, but it does happen occasionally.
But I feel like I hear it enough that I'm like, okay, I think I'm going to talk a little bit about this. So here's my 2 cents on it. I do not have adult children. I do not have teenagers. And I'm sure that's where people are getting those thoughts is I'm not passing on any money to these guys that are just rebellious, you know, little.
There might be some of that. There might be some of that.
Now, what I do have is 60-year-old parents. And I feel like right now, if I could gift them $1 million, it's going to do a few things for them. They're going to be able to retire right away. They will be able to live out their dream retirement and take vacations that they want. They're going to be able to buy a boat if they want it, right? And do all these really cool things. I feel like when I'm 90 years old, regardless of how I felt when I was 40 or 50 years old about my children, I feel like at 90 years old, I'm going to look down on my kids a very similar way as my parents. There's
so
my
you're saying take the long-term approach here. Take the long-term approach.
And at the end of the day, if you want to gift everything at 90 years old to a charity, gift it to a charity. But I will say, if you want to have the option, because if you don't prep for it in your 50s and 60s, then there's no way you can make up for it in your 80s and 90s.
Yeah, that's a good point, right? So if there's a chance you're going to do, and here's my 2 cents on this. I think that for most people, it comes as like a generational thing more than anything, right? Like now I say that, and I remember years ago. So my family wasn't like a life insurance family. My dad was a term insurance person. He happened to die at 49, and his term insurance paid out, thankfully. But he was more on the term insurance and use IRAs and stuff, right? Like all the things that we tell people, that's not the efficient way to build wealth. But I lost my train of thought. What were we talking about? Can you guys remind me?
Taking care of your kids.
Taking care of
your kids. Yeah. Okay. So
generational.
Here's what I see end up happening. People from like certain backgrounds and generations, like they tend to just think that way. You fend for yourself. So the way I grew up, it was my dad paid for a few things for us, but everyone in my family, they paid for their own college. They got jobs. They didn't get loans to pay for school even. They just grinded away. That's just how we grew up. So I remember going to a friend of mine whose dad was in the life insurance business, and their philosophy was entirely different, right? He believed in like paying for their school, helping them get the best education. Like, and I remember just feeling like there's not a right or wrong way here, but they are very, very different. Here's what I also know. My mom absolutely was looking for ways to create more money to pass on to her kids as she got older. So earlier in life, it's one of those things where it's maybe less important. And to your point, Brennan, as we get older, it just becomes something that is important. And anything we can do to make the life of the people we care about the most a little bit better, well, that makes sense to me. But I feel like I can understand where those people are coming from that are like, they don't need that much. But I think most of them, they'll come around. That's my take.
Yeah.
One angle that I hear as well is I don't want to spoil them, right? I don't want to just, they have a ton of money land in their lap and they're just going to go blow it and become, druggies or whatever. I don't know what they're thinking when they're saying, I don't want to ruin them.
We went down a steep hole fast.
I'm just saying people get worried. Okay. But my point is that instead of take that energy of that concern of, you want your children to be upstanding, contributing to the society, all this kind of stuff, and teach them those principles and how to do, how, if you have wealth, you're going to use wealth to go do those things. So it becomes a cultural thing, can become a cultural thing, because if you're just throwing the money at them and they don't know what to do with it, okay, well, who knows what they'll do with it, right? And if you're teaching the principles, then I think that it's a very different mindset that you can bring to the table.
Yeah. And I totally get that and understand that it's an early death, right? For teenagers, young adults. But man, if I lived a life expectancy and my kids are 60 and they take that money and become drug addicts, I don't know what to say.
Good on them.
I throw my hands up and I don't know.
Once they're 60, that's the point where Brennan's like, they're on their own.
They're on their own.
Take care of them from that to that point.
If they take that legacy and turn it to drug money, okay.
Oh goodness. Okay, well, now we've moved in totally into philosophy. While we're in philosophy, I'm going to do a quick tease. Our next episode, which Brennan and Blake may or may not be on, but I wasn't planning on it, so probably not. But our next episode we're going deep into philosophy. In fact, I think my episode is going to be called The Dave Ramsey Effect, Why Millions of People Follow Bad Financial Advice. So we're not just going to talk about the bad financial advice. We're going to talk about the philosophy around why people follow bad. And it's not just Dave. There's a lot of them, but we're going to talk about it. We're going to break it down. So Blake, Brennan, if you guys have any notes for that show you want to send to me, you want me to pass it along to the audience, I will be sure to do it. Okay. Thanks everybody for listening. Thanks Rod, Blake, and Brennan for being on. And we will see y'all next week.
Thank you for listening to the Money Insights Podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights Podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.